Hello traders, you are welcome back to the Forex Geek channel, and I especially welcome you to this particular video. If you are looking for a powerful yet simple strategy to use on the 15-minute chart, the best 15-minute moving average strategy is exactly what you need. So whether you are new to trading or a seasoned pro, this strategy helps you make quick, informed decisions without overcomplicating your process. Now, the 15-minute chart provides a perfect balance between speed and accuracy, allowing you to take advantage of price movements while avoiding the noise and erratic fluctuations of lower time frames like the 1 minute or 5 minute charts. Okay. Now, before we dive into the strategy, let us first of all understand what moving averages are and why they are so useful. Well, moving averages are indicators that smooth out price data to help identify trends by filtering out short-term fluctuations. In Forex, they are widely used to help traders determine the direction of the market. Let's let me just add let me just add the moving averages we are going to be using in this strategy right now to the chart. All right. So we're going to be using the 50 EMA and the 200 EMA in this video. Meanwhile, there are two main types of moving averages, the simple moving average and the exponential moving average. The difference between them lies in how they weigh, how they weight recent prices. The EMA gives more weight to the most recent prices, making it more responsive to price changes, while the SMA treats all prices equally. So for the best 15-minute moving average strategy, we'll be using both the 50 EMA and the 200 period EMA. These two moving averages are ideal for identifying medium-term trends and potential reversals in the market. Now, let us quickly set up the chart. You open your trading platform, apply the 50 period EMA and 200 period EMA to the 15-minute chart. Give them different colors for easy identification. All right. The 50 period EMA represents a shorter term trend, while the 200 period EMA represents a longer term trend. So these two moving averages will help you understand the overall market direction and pinpoint potential entry points. Okay, when the 50 period EMA crosses when the 50 period EMA crosses above the 200 period EMA, it's generally a signal that the market is in an uptrend. All right. Conversely, when the 50 period EMA crosses below the 200 period EMA, it indicates a downtrend. All right. So these crossovers are key entry signals for this strategy. Now that your chart is set up, let us talk about how to identify the best entry and exit points using the best 15-minute moving average strategy. So for a buy signal, the primary signal for a buy trade is when the 50 period EMA crosses above the 200 period EMA. All right. This suggests that the market has entered an uptrend. So to confirm the signal, you can look for price to stay above both moving averages for a few candles, showing that the trend is likely to continue. Meanwhile, if you have a choppy market, if you have price moving sideways, just stay out of the trade, like what we can see happening around here. Okay, so you want to have a clear direction. You want to have the moving averages sloping upwards. Okay, for example, here we had a crossover, and we even had price retest the 50 EMA and a continuation pattern. So in this case, you look for buy opportunities. Okay, for a sell signal, the primary signal for a sell trade occurs when the 50 period EMA crosses below the 200 period EMA. This indicates that the market may be shifting into a downtrend. So to confirm the signal, you look for price to stay below both moving averages. Once this is established, you can enter a short position. All right. For your exits, you can set a fixed target based on support and resistance levels, or use a risk to reward ratio to manage your trades. For example, if your stop loss is 20 pips, maybe um, of course, your stop loss should be above the previous swing high for a sell. But if it's 20 pips, for example, you can aim for at least 40 pips risk to reward ratio. Basically, 40 pips target, right? 40 pips in profit. But that is what we mean is a risk to reward ratio of 1:2. All right. So you can actually decide to use a fixed risk to reward ratio of 1:2. Alternatively, you can exit your trade when the 50 period EMA crosses back over the 200 period EMA. So in that case, if you had entered a sell around here, where you would have exited would have been somewhere around here. That would have been massive, right? So it depends on the exit strategy you want to use. If you want to exit when you get an opposing crossover signal, that is fine. But let me tell you a secret. Usually when the trend is strong, it's better to exit at the opposing signal. When the trend is strong, yes, when trend is actually strong, it's better to exit opposing signal, because you might not know how many support levels will be broken. So if you decide to just exit at the nearest support, it might get broken, and well, you're going to miss out on the remaining move. But if the trend is very gentle, if the trend is gentle and it's not looking like very strong trend, just use support levels or resistance levels. For example, in this particular scenario, if you had entered a buy around here, just exit at the at the next resistance, because you can see the trend was not strong. Look at how price went up and came down back all the way to this point. Went up here, came down back all the way to this point. It was too gentle. The trend was too gentle. So if you say you want to exit at the opposing signal, that means this is where you would have exited. And if you calculate the distance from here to here, it means your exit was not even far from your entry. So that's the reason why when the trend is strong, when you have a steep slope, or you will know that when the momentum is strong, you will know, right? You will know. You will see. Can you compare what is happening here to what was happening here? It's not the same. Price was coming back to the moving averages. Like, the slope was too gentle, basically. So in such a scenario, you can just use the resistance levels for a buy to exit. All right. For a sell, use support levels. Okay. Now, while the best 15-minute moving average strategy is effective on its own, you can also increase its accuracy by combining it with other indicators, maybe like the relative strength index or stochastic oscillator. They can help confirm whether the market is overbought or oversold, giving you a clearer picture of the trend. All right. So that is all for the best 15-minute moving average strategy. By using the 50 period EMA and the 200 period EMA, you'll be able to identify strong trends and make quick decisions based on solid signals. This strategy is easy to follow and can be incredibly effective for traders looking for fast opportunities without having to monitor the market constantly. If you found this video helpful, don't forget to like and subscribe for more Forex trading strategies and tips. Thank you for watching, and I'll see you in the next video.